Good morning. Thank you for joining us for this Allsop webinar, which is going to focus on central London, our capital city. My name's Ed Dunningham. I'm Commercial Managing Partner at Allsop and Head of the Commercial Valuation team. As mentioned, today's session is going to deal with the West End and city markets from both an occupational and a capital markets perspective. We've called it the flight to prime, as certainly that's how London is perceived, and perhaps at the moment it's never been more the case. We're coming to you today from a range of locations, from our city office in Copthall Avenue, our West End office in Wigmore Street, and as the weeks and days go by, we're increasingly returning to our offices in central London as London opens up. So before I introduce ourselves, just some points of order. The session today is going to last about 45 minutes. There's going to be questions to each of the panelists after each section. And if you want to get involved and ask anything, please use the Q&A function, which is the little question mark inside the speech bubbles, the icon top right hand of your screen. So please raise any questions and I'll ask the panelists if there's anything in particular you'd like to ask. So to introduce the team, in a minute I'm going to hand over to Nick Pemberton. Nick is partner and co-head of our West End team, and he also leads our relationship with Millennium Group in the Far East. Nick's going to open with his thoughts on the capital markets in the West End, and particularly what's happening and what the activity is doing at the moment. After Nick, we'll then pass on to James Abrams. James is partner and head of city investments at Allsop, and James is going to discuss the city market and the activity that we're seeing at the moment. Next up after James is Marsha. Marsha Rabinovich is an associate working with James in our city office, and Marsha focuses on investment and development work. Marsha's going to discuss a couple of the opportunities that we're active with at the moment in terms of marketing, and I'm sure it'll be of interest to hear what activity and what interest we're getting in terms of those. And then finally, we're going to swap over to the occupational markets, and James Neville, partner in our city leasing team, is going to discuss the current influences and activity in the office letting market in central London. So without further ado, I'm going to hand over to Nick. Nick, over to you, please.
Thanks, Ed, and good morning, everybody. Thanks for joining the Allsop webinar. I think it's just worth sort of taking a step back and just seeing that we came into this new year with renewed optimism. We saw the threat of Corbyn recede. We'd had an election. Everyone had stopped talking about Brexit. And Q1 in central London, we saw around about 4.5 billion traded across the quarter between the West End and the City. West End and City combined tend to do between 15 and 20 billion a year. So Q1 we were on for a sort of normalised quarter, and then of course around about sort of 17th we had the lockdown, 17th of March, and the markets understandably ground to a halt. That said, there has been some activity, but Q2 West End we saw around 200 million traded in 13 transactions. Interestingly, there were no large transactions above 50 million. And 210 million traded. If you take a typical Q2 West End volume is around 2 billion. So, you know, the market basically did a tenth of what it would normally do. And the average lot size is 55 million versus Q2 this year, which was 16 million. And there's some interesting themes here. I mean, we talk about the title of the discussion this morning is the flight to prime, and we've definitely seen that in the West End. The things that have traded are smaller lot sizes where they've understandably not necessarily needed the debt markets, which obviously put themselves on pause. But 6 of the 13 transactions in Q2 were to owner occupiers. So people have taken the opportunity of buying their own buildings, and we've seen several deals where tenants bought their own building, adjoining owners have taken it as a great opportunity to piece together a development opportunity where they've been waiting for years to buy an adjoining building, and obviously taking that opportunity during the sort of relatively weak market. But 11 of 13 transactions were freehold, and I think with this flight to prime, we are going to see a widening of the discount that long leasehold interests are offering. Largest transaction in the quarter was under 50 million, and that was a building in Marylebone Road, which is a value add opportunity with US money partnering with Beltane. But certainly, you know, some of the pricing we've seen, short leasehold, short income deals and freeholds, we've not really seen any pricing softening. We're still seeing regularly £2,000 a foot, which is you know, right up there in the West End as sort of being sort of top pricing. If we can go to the next slide, please. So I think it's worth just going through what's transacted during lockdown. So 1 Old Queen Street's a great example of this. It's a freehold modern building close to Parliament, and it was marketing commenced in early March, so just before lockdown, but it's fair to say no one actually was able to inspect. It's a government building. We looked at this for a client. There were 6 bids on this, 6-month income, then a refurb and turnaround project, and you know, half a dozen bids, freehold, 24 million, 4.5% for 6-month income. You know, that pricing is sort of pretty much the same as pre-COVID pricing. 1 New Oxford Street is a transaction everyone was closely monitoring because it was one of the larger transactions. Again, was launched in early March, and that was bought by Sun Venture, who are a Singaporean investor. There were 3 bids for that building. So, and again, that's pretty similar, I think, to pricing to pre-COVID. Another similar example to Old Queen Street with 8-year income, 3-year breaks. This was sold in April, one of the first sort of post-lockdown deals, and I think actually probably traded at a slight premium to what it had been under offer for late last year. And an example of smaller transactions, we at Allsop have got a handful of smaller transactions out in the market at the moment, and we launched this small Soho freehold in June, and we've already traded it, and we had sort of 25 inspections during June and early July, traded it for about 25% ahead of the guide, and there's really strong interest for these smaller lot sizes in the West End. They're extremely liquid. Thanks. So what's moving on from Q2, which was obviously 210 million traded. In the first couple of weeks of Q3, we saw the material uncertainty clause lifted for valuations. We saw some big transactions go through. So I think in the first couple of weeks of Q3, we pretty much almost did double the entire volume of Q2, and it definitely sort of feels and felt like there's a sort of an awakening of the market as people start to return to offices to some limited extent. We've seen several buildings launched to market, which I'll show on the next slide. But really, by and large, we've seen more targeted marketing. So people choosing to not launch a building far and wide, but go with watermarked copies and go to 10 or 20 investors. And I'll come on to sort of why in a moment. But again, this sort of flight to prime, the stock that we're seeing come to market largely and trading largely is freehold, good quality stock, where often overseas investors are really seeing that, you know, putting money into core London, core West End as a sort of more of a wealth preservation play. James will talk about the city markets being more sort of cash on cash and income returns. I think the West End certainly feels more sort of, you know, building and buying for the long term. And we think there's going to be continued liquidity for smaller lot sizes. What are our concerns? James Neville will come and talk about this, but I think in the short term there is a general market concern over tenants' grey space coming to market and a softening in rents. But you know, on the smaller lot sizes, that doesn't really translate through to a price softening, but possibly will do on some of the larger lot sizes. I think we could also summarise by saying buyers are seeking a discount, but sellers aren't really yet under pressure. They're not really, we're not really seeing pricing discounted at this stage. But equally, sellers are not necessarily forced into any situation. So there is some stock that isn't trading, but pricing isn't softening either. And again, who are the sellers going to be in Q3? Possibly some of the UK funds as they ungate. Land Securities have come out recently and brought several assets to market, which I'll discuss on the next page. But it's probably likely to be a continuation of UK vendors and overseas buyers. We're always surprised in the West End by the diversity of buyers, and I think one of our stats was I think there's been 46 transactions so far this year in the West End. There's been 45 different buyers. There's only one buyer bought 2 buildings, and that's Hines, and UK plus 13 other nationalities. So, you know, ranging from Asia to US, Dutch, Swiss, Middle Eastern. There's always a real range of buyers in London. So example of a couple of things in the market for sale. 7 Soho Square, Land Securities have brought this to market. It's freehold, multi-let, but with a block date really in 2023, and really a repositioning play. They've come out with a couple of massing studies as part of their marketing, where they think they can go from roughly 60 to 80,000 square feet. And it's been well received. I think they did over 30 inspections. They had first round best bids yesterday, and they're going to a second round bids on Monday. And they, we think 10 parties bid at first round. So, you know, interesting that you really got sort of 3-year income there. So I think the market generally sees it beyond potentially COVID. You don't really have to worry about it. You've got a couple of years to work up your scheme. And again, flight to prime, it's a freehold in a garden square. This second example, 7 Dials Warehouse, is really an example of some of the sort of grey investment stock in the market, in that it's been marketed by CBRE GI, Pan-European Fund. It's freehold multi-let, Red Bull's headquarters, good quality building, 8-year income. It had been under offer. It's been under offer twice now, but it'd been under offer in March to Capco, an obvious buyer, 102 million, 4.1%. And I think that there probably is a market for this asset at the moment, but it's slightly off 102 million. Capco pulled out of the deal, but CBRE GI, it's kind of sat there. They will sell this asset for 102 million, but aren't prepared to soften their pricing at the moment. So it's an example of something that is buyable, but you've got a seller who has a price in mind and won't deviate from that, we think. Thanks. I'll pass back to Ed now.
Thanks, Nick. Just a couple of questions for you. One of the things that we've discussed in the past is the amount of space that's quietly on the market in London at the moment. And you know, how much space do you think is being sort of quietly pushed out there, and why is that the case?
So investment stock.
Yeah.
Yeah. I think there's a huge nervousness at the moment to undertaking a broad marketing campaign on an asset, and one of the main reasons for that, I think, is because of the inability for overseas investors to travel. I think there are assets where if people put widely on the market for a price and they don't get that price, and there's a concern that the valuation might therefore soften as a result, and the asset might be tainted. So there's definitely a more of a sense of a targeted marketing campaign. But I can think of, for example, the Westbury Hotel and adjoining Burberry block on Bond Street. That's quietly available. That's £1 billion. Camden Market, that's another £1 billion. There's probably 111 Strand, which is sort of 75-80 million, 4% long leasehold, that's quietly available but hasn't gone far and wide, and brochures being watermarked. So I think it's probably, I would guess off the top of my head, about £3 billion worth of stock that's kind of quietly out there.
Yeah, that's a fair bit, isn't it? Yeah. I mean, in terms of, obviously people are returning to the market steadily now, and after this crisis, how competitive do you think London is now compared to other global cities?
I think we have tie-ups with a private bank, and also with our Millennium relationship with Asia, and we speak to a lot of private investors about the West End, and a lot of them have this view that London's been here for centuries and will continue to be here, and it's the West End in particular is very much regarded as a store of wealth. In terms of yields, our yields are probably 100 basis points discount to places like Paris. These investors are truly international. They're looking at places like Sydney and Tokyo at the same time, and there's virtually no supply of investment stock in a city such as Sydney. So it's very competitive as a market. We've got very low vacancy rates. There's a lot of positives about the London market. So I think it is discounted to other European cities and other global cities.
Brilliant, thanks, Nick. That's good to hear. We're now going to move from the West End over to the City office, and over to James Abrams. James, over to you.
Morning, Ed. Thank you, everyone. I'd like to just start off with what we've done in Q2. We're going to compare it to what happened in Q1 2020, where it was basically one of the highest ever transactional volumes that we've seen, certainly in the 2 weeks following the election result. Even then, there was limited buying opportunities. There was about 23 deals exchanged, and we had a value of just over 2.3 billion within the 1 quarter. As an example, that was actually down 46% on the previous quarter, so the back end of 2019. For Q1 that's just passed, we saw average deal size was about 85 million. Which is quite important to remember when we come on to Q2, because what we saw then after the election result was a large number of people who haven't been around for a while coming back into our market, and this included some German funds. We saw activity from Decker, from Union Invest, who came and bought 2 large buildings, as well as some private Greek money who came in and bought a large vacant building. HB Reavis actually bought a building in Shoreditch for one of the highest values for a site that we've seen for some time, as well as some of the UK institutions coming in as well. So comparing it to Q2 that we've just seen, which is from March to June this year, we recorded just 9 deals, which totaled 293 million. And this was 84% down on what we saw in Q1 2020, and 71% down on the same quarter from last year. Average lot size was around 32 million, which compared to the previous quarter of 85 is significantly lower, with nothing recorded over 100 million. So what we're seeing now, though, is a slight uptick, and what we have just seen is a few deals that have exchanged, which start to show a lot more confidence back in the city and the city fringe. 10 Fenchurch Place was recently bought by Mighty Divine, who are Far Eastern capital. This is a deal that had been under offer pretty much prior to Christmas, and eventually did happen. It reflected 4.3% of rented multi-let income, and this was a capital value of £1,231 a square foot, which I think is fairly reflective of what we were seeing towards the back end of 2019. Following that, we've also just seen quite a hotly contested building, which Helical Bar was selling, and this sits adjacent to Farringdon East Crossrail station. Once again, multi-let, rat rented, and this was newly completed, and this was traded at 48.5 million, purchased by the French institution, Le Francais Group, and they paid just sub 4% and £1,568 a square foot, which is pretty close to a record for Clerkenwell and Farringdon. Along the same kind of tune, there is a building called Chapter, which is sits on top of Old Street Roundabout. It's an old converted school, very trendy tech type building, and this was purchased by a private Russian investor within the last 2 weeks. He paid 45.5 million for this, reflecting 4.5% on rented income, and £1,338 a square foot, which is also a new record for the Shoreditch market. Just coming on to what is actually available in the market for sale at the moment. Exchange, you probably saw it in the press in the last couple of days. This is building in Canary Wharf called the Cabot. Substantial asset, about 50% of it is let to Morgan Stanley, about 30% of it to the UK government, and it has an average unexpired term of around 11 years to break. And this was bought by Link REIT, who are one of the largest REITs in Hong Kong, purchased off Hines, and they paid 4.75%, £800 a square foot. But It's the reasoning behind this that is very interesting, which is the debt for this was really attractive, and they were able to see a cash-on-cash return of over 8%. And we're pretty confident that, once again, on this one, I'm not sure that they came to see it either, very similar to 1 New Oxford Street, but they're chasing yield. Another one that is recently come to market is the Mark Lane estate. This is 132,000 square feet of offices. It's got a natural break date in about 2.5 years' time. Potential to add a floor, do some infill, but also to potentially knock it down, start again, and take the building up to about 320,000 square feet, subject to planning. They bought this out at just over 100 million, reflecting effectively a vacant possession value of nearly £800 a square foot. A couple of other things which are in the market which I think are definitely worth noting. One Great St Helens is a building which sits adjacent to 22 Bishopsgate, which is the 1 million square foot access scheme. The tenant in here have been here for 20 odd years. It's Hiscox. They've actually signed to move into 22 Bishopsgate. So this will be a freehold refurbishment opportunity with the potential to add 3 floors. It's very traditional city stock, and it's going to be very hotly contested. But really, the interesting part about this is that it's essentially a vacant building, which is also reflecting about £1,000 a square foot. And we were saying that if you take this back about 4 years, £1,000 a square foot was considered expensive for newly refurbished, multi-let, rack-rented investment stock. So you can really see where the market's moved on to. Another building which has recently come to market, which we're selling from our office here, is a building called Warehouse K down in the Royal Albert Docks. This is a listed warehouse of just over 100,000 square feet. We've recently let just over half the building to the UK government. It's the Home Office have taken a 15-year term here. But even though they pay £32.50 for their accommodation here, the whole building's passing off £23 a square foot, and we have an average unexpired term on the investment of just over 12 years. We're looking for 48.5 million, which is just shy of 5%, and sub £500 a square foot. But this sort of sits on top of Custom House Crossrail Station, and we believe, from the debt that's available that we can see, once again, you can see a cash-on-cash return of over 8%, depending on what kind of lender you end up going with, which is very attractive. So looking ahead, who are going to be the vendors? We can certainly see a lot of activity from high net worth individuals who have seen substantial growth on their assets over the 4 or 5 years that have just passed. Certainly you can see over the last 4 years where we're selling refurbishment or vacant opportunities of £700 to £1,000 a square foot. There's some considerable growth over the last 5 years there for them to take advantage of. The city, as opposed to the West End, has always represented yield. And when you compare it to, Nick was talking about Paris, but also various parts of Germany, multi-let, rack-rented, newly refurbished buildings are trading in the low 3%. And with the pound where it is at the moment, currency will continue to play a major role in that. But certainly, these cash-on-cash returns that you're seeing, anything north of 6.5%, is going to be very attractive to international investors. There is, however, a bit more of a concentration on what's going to happen following COVID, and we are having closer attention being paid on space planning of particular buildings, what type of air conditioning we're able to use, and also, that sustainability question is very front and centre for a lot of people. But having said that, our market will continue to be dominated by debt-backed buyers, and while we have interest rates which are at historic lows, people will look to the London office market for the cash-on-cash returns that hopefully will be here for some time. We were expecting to see a lot of the old money come back in, a lot of the REITs to take advantage of people selling assets. This is a good time to go and pick up a trophy asset, but it does appear to be dominated still by the overseas and those people who have the cheapest cost of capital. So I'd just like to pass back over to Ed now and ask if there are any questions.
Thanks, James. That's excellent. Just in terms, it's good to see there's some comments on City Fringe and the core. I mean, how do you see the two different areas having come through the crisis? Is it similar in terms of demand and interest? How have they both fared?
Yeah, I think you can see from some of the examples that we were just talking about, the City Fringe is actually hitting record pricing, and I think a lot of that has been pushed by the tech market, and you can see a lot of the tech occupiers are doing quite well. I think it's also, they're slightly smaller lot sizes, so they're more around that £50 million mark, which people feel very confident with. I do, however, believe that we're about to see quite a lot of activity in the core when the Far Eastern capital and certainly the German funds start to travel again. And I think that will come towards the back end of this year or early next year.
That's good. And just in terms of infrastructure, how do you think that's affecting the Fringe at the moment? Is that a big factor?
I think absolutely. Yeah, we've been talking about Crossrail coming for a long time, and I think there's always been that question of, is it already priced in, the Crossrail opening, if it opens soon? We're about to experience that with Warehouse K. It sits on top of Custom House Crossrail Station, and I think I'll be able to answer that when we get that exchange. And I think that will be a very good barometer for how infrastructure pushes this.
Brilliant, thanks, James. We're now going to move over to Marsha, and Marsha, hi, who's going to talk about the experience we've had in the market recently. Marsha, over to you.
Hello, good morning, everyone. Yes, so Allsop have been in the market with 3 development sites since April, launching all 3 of these sites really when we were right in the middle of COVID lockdown. I'll talk you through 2 of these, which you see on the screen in front of you now. So 60 Aldgate is located on Aldgate, just across the road from Aldgate Station. It is currently a cleared site and forms part of phase 1 development at Minories, which also comprises a hotel, which will be open at the end of this year, and a self-contained residential tower. The office opportunity is currently a cleared site and was offered to the market in conjunction with TfL on the basis of a new 500-year leasehold interest from TfL alongside a development agreement to permit the scheme to come forward. The opportunity itself currently doesn't have planning, albeit we believe it would be forthcoming this year. And it was really offered to the market on the basis that somebody could come on board now and see through some of these outstanding work streams. We were inundated with interest on this, in the end receiving over 10 bids for the opportunity. And we are firmly now under offer, well in excess of the £40 million quote price. 39 East Road is located just north of Old Street Roundabout in Shoreditch. It is a freehold site, and we successfully obtained planning consent for this opportunity in July. The opportunity provides for a 23-storey tower comprising of a 210-bed hotel set on top of just over 26,000 square feet of office accommodation. We've launched this to the market about 2 weeks ago now. We have been inundated with interest on this again, and this time from various types of operators as well as investors looking to forward fund this for operators as well. Now, one thing that was clear from our marketing campaign is that the demand for opportunities that permit the delivery of good quality space in London is still very strong, despite all the uncertainties in the market. And as I touched upon before, this was particularly evident from our recent marketing of 60 Aldgate. The bidding was extremely competitive, and we actually ended up going to 3 rounds of bidding. Bids were received from some very notable players in London's development circle, including REITs and well-known development companies, and we even received interest from some overseas buyers. These companies all expect life to return to normal eventually, and London to continue its position as one of the world's greatest commercial centres. A lot of developers see this period of uncertainty as an opportunity to finesse and execute their business plans, whether that be by piecing together site assemblies, working through planning applications, to ensure that they are relevant for the emerging occupational visibility and accountability. We're constantly reporting on disposal strategies on behalf of clients who have interest in land ripe for development, but haven't quite de-risked their sites and are looking for creative ways to extract capital today in order to recycle it into alternative business streams. It is our opinion that offering value-add angles, phased capital disposal programs, and creative joint venture structures are key to unlocking the value of future development sites. The demand for these opportunities exists, but finding them is the hard part at the moment. Thank you.
Thanks, Marcia. I mean, clearly these are two interesting medium-term development plays. Were you surprised by the level of interest that we got?
I think we always knew that these would be very well received by the market, but we were definitely surprised by the number of parties that evaluated these opportunities. We think that for schemes that aren't being delivered for the next 3 or 5 years, there's definitely a lot more demand than those that are refurbishment opportunities that have a much quicker turnaround time.
Is that really what people are looking for, the sort of medium, longer term view?
Yes, because they're able to infer, more certainty into those opportunities and appraise them. Whereas at the moment, nobody quite knows exactly what it is the market is after and where rents or yields will go.
Fantastic. Thanks, Marcia. We're now going to move over to the occupational side and over to James Neville.
Thanks, Ed, and good morning, everyone, and thank you for joining the Allsop webinar this morning. As leasing brokers and advisors, we often want to push the ever upbeat positive signs in the market. And the issue is, in the current climate, we need to be realistic, and we really need to inform our clients on the reality of the property market. We may joke here in our social media on the first slide, which shows the merged months of lockdown, but it does really reflect the reality of the agency market, where we've had a strong start to the year in January and February, and then we've seen a challenging 6 months before we expect it to really come back and start to recover through September through to December. But on a positive note, we have seen gyms, restaurants and bars now reopen, and there's more choice in the city market now than just your typical M&S sandwiches or your pret-a-manger until 2:30 in the afternoon. Many of the investment markets are now increasing their return to the office, and business is gradually working towards being operational in the city. We've seen more recently the likes of Goldman Sachs suggesting that they've got 700 people now back in the office. As of yesterday, we've also seen Barclays announcing the return back to Canary Wharf, which is great news. There are some high-profile exceptions, however, and these are the likes of RBS, KPMG, PwC, and the tech giants Facebook, Twitter, and Google, who are all announcing their return come the new year. So just looking at the statistics, Q2 take-up for central London was just over 1 million square feet. This is 68% down on normal, unsurprising really, but some of the lowest take-up levels that we've seen on record. There remains 8 million square feet of demand and 2.6 million square feet under offer, but many of these deals have been withdrawn or placed on hold. Most recently, we've seen the likes of Kirkland and Ellis, which was in the paper yesterday, withdrawing from the likes of their shortlist of Threadneedle Street. We also saw Rabobank withdraw from the Bloom just opposite Farringdon Station, where they were due to take 90,000 square feet. Lazard's in the West End. Amazon, their web services arm, withdrew from 2 Gresham Street for about 200,000 feet. And Salesforce put their expansion of 114,000 square feet on hold at 80 Fenchurch Street. Mondrian and Allianz Bernstein also were looking quite extensively at 60 London Wall, and I understand there are negotiations still ongoing there, but their requirements potentially on hold. But the positive shift from that is that the vacancy levels remain very low at 5.8%, and this is coming into a recession where historically in the early 90s the vacancy rates were right up at 20%, and then more recently in 2008 we saw vacancy rates at around 14%. So still very, very low. Grade A stock is extremely tight in the city core, and there's also an increased delay on a number of the schemes because of lockdown, and we're now expecting this shortness of delivery into 2022 and beyond. Supplies increased by about 20% on the previous quarter, and this is due to the levels of second-hand space. Allsop City Office have seen really about 250,000 square feet of space coming back to us. This is predominantly in the city fringes at the moment, and this is largely down to a number of the occupiers being in the hospitality and the retail and aviation industries. So in the ongoing uncertainty of COVID, it's really fantastic news that there have been some key transactions that have actually signed since lockdown. A number of these were agreed pre-lockdown, but subsequently were still committed. For example, BP signed at 200,000 square feet down at Cargo in North Colonnade. This is rumoured to be, but very much undisclosed and confidential, supposed to be around £50 a foot, and committing to a 15-year term. And then in the city, we've seen the professional sector be quite active. Early on in the quarter, we saw Covington and Burling sign at 22 Bishopsgate, rumoured to be around about £95 a foot there. And again, 15-year commitments, which is very strong. And Baker & McKenzie, as of last week, signing a Duo in 280 Bishopsgate, where they've rumoured again to have paid something in the late 70s. Then at Allsop, we have also been using a COVID tracker where we're monitoring a number of deals over 15,000 square feet. And you can see here that both signed and under offer, we have about 73% continuing. So that is good news. And those withdrawn around about 27%. So how has COVID affected the occupational markets? We all know that in the last 3 months, working from home has been extremely successful, and we've all got used to the more permanent desks and one-way circulation systems. These are all short-term solutions though, and developers are really going to have to drive the boundaries of future development for the long term. These will include smart building technology. We're including this in a number of our designs now, sensor entry systems, and better end of trip facilities to encourage people back to work. In addition, we are seeing the wellness provisions and cycle facilities coming into play. But on top of that, we're now seeing a number of businesses looking for personal trainers entirely for their business, or additionally health advisors, and also occupational psychologists in some instances. So we will see this flight to prime for new core requirements, and really for occupiers wanting to deliver the best environment for their staff. So in the short term, we'll see a number of corporates release grey space into the market, but this is really likely to take place during October and November as the main corporates start to focus on their office space once they're back. And as I mentioned earlier, we have seen this quite extensively early on in the city fringes. We're also likely to see this pent-up demand and more pre-lets moving into 2022 and 23. For example, the Rabobanks of this world have just extended short-term for 4 years, as have Kirkland and Ellis for 5 years. So they will be back out into the market looking at that pre-let opportunity. We're also currently witnessing the majority of our demand from the sub 5,000 square foot market. Allsop City team here, we've just, as of today, registered 72 viewings since the 5th of May, which I think is very positive, but the majority of those being sub 5,000 feet, and we've had maybe 2 or 3 in excess of that and 10,000 feet upwards. Now moving on to the serviced office sector, we know that this has been hit extremely hard over the last 3 months. and the likes of WeWork and Regis all suffering quite significantly. I think the likes of WeWork will be here to stay, and they will come through into 2021, but they have been dropping a number of their secondary and tertiary buildings and been looking to renegotiate, having appointed Knight Frank on their portfolio for renegotiations. But we do know that they're continuing to pay their rents with their core stock, and those buildings where they have a number of enterprise clients are already committed and signed up. Some of the smaller serviced operators will, I think, certainly struggle to come through into 2021, but those who fared quite well will be looking at turnover rents as well. We've also already experienced the likes of the Office Group coming back into the market for a turnover platform, and a few others like TechSpace, for example. So thank you very much, and back to you, Ed.
Thanks, James. Just a couple of questions for you. Clearly, the commuter trains at the moment are quiet. They're slowly picking up. But how can landlords, how can authorities get people back into their offices?
Yeah, I think the trains are certainly picking up. I think the numbers on my carriage this morning were looking quite positive. I think we increased to probably 20 in a carriage now, whereas a month ago it was probably just 5. I think it's very difficult for the government at the moment to really insist on people coming back, but they have made positive signs in that they're putting the onus on employers to make that decision from the 1st of August. And I think the announcement of Barclays is a real positive sign, and I think that will create more of a sentiment towards a return. I think landlords, it's really making sure that the buildings are all COVID compliant, and I think a lot of landlords have already done this and ensured that that has already been in place for those that have been working to date. And then it's all about really driving the wellness provisions and that incentive for that end of work offering.
I suppose, we wanted to do this webinar before the summer break in August. September, presumably there's an expectation that people will start to return in more numbers.
Yes, certainly a number of sort of investment bankers that I've been talking to are all discussing it. Whether it's going to be in full force, I suspect probably not. There's still a number of people, the likes of ICAP, running the oil rig system where they do 1 week on, 2 weeks back working from home. But I think the driver is to encourage more people back, and it will lead to a gradual increase between now and through to December/January, I believe.
And just finally, James, in terms of fit outs and what people are wanting in terms of their, the design of their offices, what changes are you seeing? And do you think these will stay, or will we go back to how we were in terms of levels of density in offices? And clearly there's more demand for outside space, I think, as well, isn't there? Yes,
I think there's definitely a change. There's no doubt that we will come out of this with a change in that design. WeWork are already making significant changes. They were running their densities on the basis of 1 person per 4 square feet in the tightest of collaboration areas. That has got to change. I think people need to be comfortable that they have more space. So the typical occupancy ratios for the office environment would be 1 to 8 pre-lockdown. I suspect that will increase to 1 person per 12 or even 15 square meters. But it's still very early days. We need to take stock, and there will be changes afoot, and particularly on this amenity element, the wellness provisions, and also a number of sort of office ground floor facilities, for example.
Brilliant. Okay, thanks, James. That's excellent. it's now back to me then, just to summarise. Clearly that transactions and leasing take-up have fallen in Q2, but I think we're certainly seeing on the investment side things are picking up rapidly with people returning. The material uncertainty clauses have been lifted from valuations a few weeks back now, and this is giving people comfort in terms of their business and transacting. I think certainly rents are under pressure, and there's a bit of softening going on that we think will continue in the short term. But this is very much expected to bounce back, and certainly the better grade A stock will bounce back because fundamentally before this crisis vacancy levels were at an all-time low anyway. And I think this is also borne out by the fact that the investment markets, we're seeing the transactions coming through now, and yields and capital rates are holding up very well. There is huge demand for London from a global perspective, and that's supporting that. And I think in terms of Allsop, our position, we've got a fantastic view of what's going on. At the moment, we touched upon how many transactions are being widely marketed. I think the statistics are there's only about 7 transactions or investment transactions being widely marketed in central London. And of course, from our perspective, the attraction of London is huge. I mean, our final point, just to summarise, the heading of this webinar was very much a flight to prime, but I think the conclusion we're drawing is actually it's a flight to London. That's it then. Thank you very much. It just leaves me to say thank you to all the panelists for their contributions, and thank you for everybody for tuning in and joining. We're going to leave the slide up there for people to see everybody's contact details, so do get in touch. Thank you for joining us, and anything else you'd like to ask, then please don't hesitate. That's me. I'm going to sign off. Thank you and good morning.